Just to introduce myself, I'm an assistant professor at CSU. I teach cybersecurity and networking, quantum computing, along with the blockchain courses. Before I was a professor, I was in industry, which brings a unique perspective into the classroom. Because if you talk to typical professors who graduated with a PhD and just started teaching, they're good, they're academics. But if you're a pure academic, you never had any real world experience. You're in the ivory tower. I've had one leg in industry and one leg in academia, so I get to talk about war stories. This is what happened when I worked with Scotland Yard living in Europe. This is what happened when I was working with Homeland Security on this particular cybersecurity breach. When you tell stories, stories stick in the brain. But if you just give students facts, facts go in this ear, 3 minutes later they fall out that ear, and nothing's left in the middle. And that's just a way of teaching I don't like. I like to cement things into demonstrations and stories and things like that. So I'm still associated with industry, but we'll take my university credentials for the time being that I probably know what I'm talking about. So what we're going to talk about probably today is what is this thing called blockchain? Notice I didn't say the word Bitcoin yet. We'll get there. How does a blockchain work? A really good question. Is it only good for cryptocurrency, trading money around? No, it's good for a lot more things than that. So some of these may surprise you. I'm going to show you some various wide-ranging applications. And finally get to this part, the money angle. Okay, so we'll start with the definition. What's a blockchain? This is the best picture I have of a blockchain. It's got blocks and it's got chains. Questions?
Got it.
Got it? Good. All right, what's inside a block? Data. Oh, thanks, Joe. Got that. So, what kind of data? Well, transactions. I'm going to sell, I got 50 Bitcoins, I'm going to sell 2 of you. So it's a transaction. That's a piece of data. You're going to sell one of your 2 now to another person here. That's another transaction. So transactions are something that can be inside a block. I'll come back to this. But then it's got this chainy thing. What's that got to do with anything? Well, it turns out the chainy thing serves a really useful function. This is a one-way process. It grows over time, adding more and more blocks as people keep doing transactions. So you can keep adding to the end, but this chain locks the past. You put something in a blockchain, it's there forever. That's a lock on the previous blocks. So think of it that way. All the blocks are linearly chained together. You can add another one to the front end. You can't change one in the middle. You can't change and add something in the middle. You can't change the past one. It's locked. Let me give you a university-ish definition. Get ready. In one sentence, a blockchain is a distributed data structure that takes the form of an immutable appendable ledger maintained by a network of peers rather than a central authority, and that uses cryptography and consensus to ensure consistency. Got that? Good. Because that's what I would teach in my class. And you're thinking, say what? That's a mouthful, right? So let's break it apart and look at 3 of the words in that long sentence and see if we can sort this out to make sense. So, some properties of a blockchain, that Lego chain I just showed you. One word in that sentence was the word immutable, unchangeable. Second word was distributed. It's not centralized somewhere. It's spread out with multiple copies everywhere. And the third word is a ledger of transactions, for example. Let's look at these in pieces. Immutable, first word. There was, if you remember the advertisements a few years ago, what happens in Vegas stays in Vegas. Well, this is on blockchain. What goes in a blockchain stays in a blockchain. The only operations we can do is create a brand new block, put it at the front end, and then read stuff anywhere on the chain. But you can't delete and you can't modify, which gets to this unchangeability nature. This is a very useful property, as you'll see in a few moments. Another word is a ledger. Well, you should be used to ledgers if you've done any accounting in your life, like a checkbook. Here is, instead of a name, a number. And it's a transfer to this number. These are people. And this is my anonymous identification. I want to transfer money invisibly. It's sort of like, if I gave you a $100 bill and walk away, did the government record that transaction? No. It's just between you and me, and I'm not going to give you $100. You can keep looking at me like that. Maybe 5. But that's an anonymous transaction. Is a credit card transaction anonymous? No. Your number, you left a digital footprint so big in so many clearinghouses, and it goes through so many banks that it's really, really visible that you transferred some money to buy something at Amazon or wherever. But this says, I'm transferring 3 Bitcoin from here to there. I'm transferring this 12.345 Bitcoins from here to here. So that's a ledger. People are used to that concept. But unlike bank ledgers, what's this word distributed got to do with anything? Here's your classic banking application with clearinghouses and banks. There is a central one ledger. And this doesn't necessarily have to be just for money. Turn this from financial transactions to votes. There's one ledger counting place where we keep registered voters, and we kind of try to keep track of that. But in any event, if there is a central clearinghouse, a central ledger, just one copy, it means somebody's in charge, right? If I'm banking at First National Bank and Trust, it's First National Bank and Trust's ledger. I do a transaction, I write a check, I do a credit card transaction, whatever, it goes on their ledger. I don't own the ledger. Blockchain is different. There is no owning central authority. Instead, we have this distributed map where everybody who wants to participate can, if they want, have an entire copy of the entire blockchain and add a block and do things like that. I have my little laptop here, the complete Bitcoin blockchain. I have also the entire Ethereum blockchain. I could get others if I wanted to. Other people around the planet have their own copies. They must be in lockstep. If this person over here adds a block, it connects to the peers and says, hey, I added a block. Okay, I'll add that same block, I'll add the same. Everybody is following in lockstep so that everybody has the same identical copy of the ledger. It's a shared common ledger, not owned by anybody. Okay, interesting. What's it good for? What? No single control point. We just did something. We said we don't need no stinking central arbiter for the transactions. Instead, we're going to assume this person doesn't trust that person, this person doesn't trust this person, and this person just hates everybody. But they all agree that the data in this block that's about to be added is valid. You're spending 3 Bitcoin. Before it goes into blockchain, somebody checks. Do you have at least 3 Bitcoin to spend? If you have 2 Bitcoin and trying to spend 3, yeah, that's not going to go to blockchain. So everybody's checking everybody, and then when everything is verified, only then will that block get added to the end of the chain. It's a group effort, in a sense, and group verification. And people can disagree and argue. But in the end, they will come to a consensus that says more than 50% of us, 51% of us, probably 99% of us, agree this is a valid block, add it to the chain. Which is all about the word trust. As I said, I don't trust you, you don't trust me. Mutually distrusting entities are still going to agree, yeah, this is okay to put on. So, but what does this solve? Why don't I just have what we had before, a central bank, a central clearinghouse, the owner of the ledger? There's no owner here. There is absolutely, nobody owns Bitcoin. Nobody controls Bitcoin. Kind of a weird situation. Well, we've had banking for thousands of years on this planet. And we've had centralized ledgers for thousands of years. And there have been, dare I say, crooked banks. I can be bought. I know you can. You want that $100. So, if I can be bought and kind of change a ledger entry from, say, you thought you had $1,000 in your account and I just forgot and added a couple extra zeros, who's to check me? So now you have $100,000 in your account. Well, auditors might check me, but in general, these things can be as crooked as the day is long, especially Nobody we trust, these days, elections. So could we reach consensus on a blockchain-run election? So before it can be recorded in a blockchain, people are verifying the data that goes in and they're cross-checking each other. And only when they come to an agreement is that added to the end of the blockchain. So those are some of the mechanics. Let's go just a little bit deeper into how that works. But first, with those mechanics, what can we do with them? Well, it turns out the fact that you can't change anything once it's put in there, the fact that it's distributed worldwide, that you can put data in these blocks, like transactions, it is revolutionizing all of these industries. And people are building applications using blockchain not as their main, it's not their business through blockchain, it's in what's called an enabling, it's a hard phrase to say, an enabling technology, a substrate, that enables them to do all sorts of things they could not do before. And as I said, I'll show you some examples here in just a few short minutes. But let's go a little deeper. What's inside? What are the mechanics? You know that we can add a block, lock it with the chain, add a block, lock it. Anything back here, if I try to change the data back here, is going to be so quickly detected, you just cannot do it. It's immutable, it's unchangeable, but we can't add a new block over time, and another one, and another one. Okay. First rule, anybody, if it's a public blockchain like Bitcoin or Ethereum or Dogecoin, anybody can participate. You can participate. I'll show you how to participate towards the end of the speech. You can play the game in two ways. You can be just a plain vanilla participant. I want to do exchanges. I want to buy and sell and trade Bitcoin or Ethereum or Dogecoin. You don't need any credentials. You don't need to be somebody special to join the club. You just create something called a digital wallet. Just download an application. I have one here on my iPhone. And let's just bring it up for fun. This is my Coinbase account. And I don't think you can see this number, but I have $755.92 worth of Bitcoin, Dogecoin, Ethereum, and Cardano. So this is my active wallet, and I can push a button and I can do a trade just immediately. So I can get you some points if I want to. If you had an account with a number. So you have to be a player. You have to have a digital wallet. These digital wallets can create something called private and public keys. This is a cryptographic technique that I'm not going to go into detail on how they work. Suffice it to say, the words make sense. A private key is something you better keep safe to yourself. Don't tell anybody else. This is while you authorize a transaction. I, Joseph, am selling this number of Bitcoins to Mr. Jim Robish in the back there. And I'm showing and proving it's me by signing this digitally with my private key. The public key, everybody in the world can have. And it's used to verify. Did Joe really sign this? If the keys intermatch and link together, yes, it's legal. If they don't, somebody's doing a forgery. So this is protected with cryptography. That's why it's called cryptocurrency. If you wonder why is that weird name there. So, an example transaction, send 2 Bitcoin to, now I might know that this is Jim Robish's anonymous ID, but nobody else will. So every transaction is sort of like that cash thing I was doing with you earlier. How do you trace these things? Well, all you know is a number. It's like a Swiss bank account in a sense. Okay, so you create a wallet. See that I have a wallet right here on my phone. I have another wallet in my laptop. I have accounts. How many accounts can you have? Pick a number between 1 and a zillion. I have created hundreds and hundreds of accounts in my one wallet because I want to spread the money around. If I want to make transactions invisible, I'll take a big amount of money, split it up among a number of small ones, and then do transactions from the smaller ones. And this way it's kind of spread out. All right, if anybody can put stuff in a blockchain, what kind of stuff? Well, we already have this old stuff. We're going to create a new block. What happens is, from my wallet, I say, I want to send 2 Bitcoin to Mr. Broker's, that number, and I send it to the blockchain network. The wallet does this automatically for you. When that happens, there is another group of participants in the blockchain called miners, like MetaMiner, 49er, and a dollar, Clementine. So miners are the ones that actually create the block and append it to the end of the chain. Nobody, if you're just a regular participant, you're just submitting transactions. A miner's got to actually create the block. So what they do, since information is stored in blocks, like the transactions, here's my set of transactions. I'm a miner. I say, oh, here's the unverified, brand new set of transactions. I'll just collect a bunch of them, and I'll create a block. And as I do that, I'll verify that each one is valid. You actually have the money to spend. There's a problem in blockchain called the double spend problem. People want to buy a Tesla. I myself would buy the Ferrari Testarossa, but it costs money. So I might have to spend 10 Bitcoins to buy my Testarossa. And all I have is 10 Bitcoins. But I'm not a selfish person. I want my wife to have a Testarossa too. So, being madly in love with her, I will take my 10 Bitcoin and attempt to do another transaction with the same 10 Bitcoin, spending it first for my Testarossa and once again for her Testarossa. Yeah, that's a no-no. It's going to be detected. The miner's going to say, you just spent that, your balance is zero. You can't spend 10 coins out of zero. It just doesn't work, and they're going to throw that transaction out. So this is the concept of validating things before they get added to the block. Now, once they're blocked, they create something called a hash. A hash is just a digital fingerprint. They create the block, they create the hash to make sure it's locked with the chain so that nothing can change in the past, and they're going to add it in, but they cannot do it just like that. They actually have to go through an interesting process. And this is one you probably read about. Mining. Mining, I take my list of new transactions, make sure they're all okay, organize them into the new proposed block. It's not on the chain yet, just a standalone block I created in my computer. And then I have to solve this ridiculously hard computational puzzle. It could take trillions and trillions and trillions and trillions of computations before I crack the puzzle. I won't go into what the puzzle is, it's a cryptographic puzzle, but it's hard. And so you may have seen pictures, there are some here in Fort Collins, of blockchain mining rigs. And if you see a picture of one of these things, you'll see row upon row of these machines sitting in racks, big fans trying to cool them down, eating up electricity like there's no end to electricity, for no useful purpose. All it's doing is solving the puzzle, and I've got competitors. Other people around the planet are trying to beat me at solving the puzzle. Why is it a competition? Because the first person to crack it and to take that block and append it to the end of the chain gets what's called a mining reward. When Bitcoin was first invented, the mining reward was 50 Bitcoins. It's not anymore. Every so many years, it cuts in half. So it became 25 Bitcoins, then 12 and a half Bitcoins. Now it's 6 1/4 right now. It's going to half again another thing. And by the year 2040, the reward will be zero. So you say, what's going to motivate miners? Well, there's one other motivation. They also get transaction fees, a little bit of money from each person that tries to do a transaction. What this is like money, it's, call it built-in inflation. It's actually increasing the supply of money in the total pool of Bitcoins available. So in the early days, somebody mined a block, got 50 Bitcoins, and it was just created out of nothing. It's like running the printing presses of the government. I just created $50 more, created 50 more Bitcoins, and now I can sell them and trade them, do what I want. And somebody else cracks it, they get 50 Bitcoins, and so the supply of money grows over time. To a total of, I forget what the exact number is, 112 million coins or something like that, where if it was real money, each Bitcoin would actually be worth $514,000. So $46,000 for Bitcoin today is meaningless. But the whole trick is, you want to earn that 6.25 Bitcoins, you got to solve that puzzle. And what's your profit margin? Well, let's see, I just bought $100,000 worth of computers. I just bought $100,000 worth of electricity and $100,000 worth of air conditioning. So, profit is one big number subtracted from another big number. Expenses, net revenue. What's left over is what you earn. That could be a smaller number. So it's only really profitable if you join up with other miners around the world and form a pool and share your rewards among each other. Hopefully your pool will crack the code before somebody else. So it's a weird system, but it prevents that double spending problem. We make sure that enough time has elapsed that if somebody said I spent it and you try to spend it a second time, that mechanism prevents that from happening. So this is how money is minted. Okay, so we have the miners, we have the participants, And we have these mechanisms in place. But what else in terms of the guts on the inside? What else is, well, you told me about transactions. I'm trading or giving 3 Bitcoin to you or to you or to you. That's a transaction. That's pretty normal. Bitcoin's really good at it. But what about other kinds of data? How about property transfers, or votes, or a song, or a poem, or art, or documents? How about software? All of these can go into a blockchain, not just transactions. And once they're put there, what goes in the blockchain stays in the blockchain. It's there forever. We're going to talk about something called NFTs, digital art, put on the blockchain towards the end of the talk. So just bookmark that. It's a weird world out there. But I do want to talk a bit about smart contracts. Why would you want to put a piece of software in a blockchain? So let me just give you one example. There's hundreds and hundreds I could give. If you're in my class, I'd make you solve all of them, Dr. Evil. Suppose I have a really brilliant idea. I think we should make a Framus. And this Framus is going to be awesome. It's going to make millions of dollars. But I can't build my Framus until I get some funding for it. And this is why we have bankers and venture capitalists and angel funders and other ways that people start up companies. They need funding. They need several $1 million. Well, why should I have to go to a venture capitalist? Why don't I instead, just on the Ethereum blockchain, say, I'm going to put a smart contract which can trade currency for me, and I'm going to advertise on a website, hey, I am starting Joe Corporation. And Joe Corporation is going to build a Framus, but I need $2 million before I get started. So if you will crowdfund with me, you can put in $1, you can put in $100, you can put $1,000, you can put in all $2 million for all I care. But I'm going to invent a new currency, real easy to do that, called Joe Coin. And Joe Coin is going to fund my Joe Corporation. And I'm going to put out this advertisement that says, buy some Joe Coin from this blockchain. So you can go there, you get on the website and say, yeah, I'm in for $500. So you buy $500 worth of Joe Coin. What the smart contract will do is it'll put a deadline. It'll say, if Joe meets his goal of $2 million by, say, it's an appropriate date for my company, it'll be April Fool's Day, so April 1st. So if I make the $2 million by April 1st, the clock ticks, and the smart contract will say, ta-da, you met your goal. Here is the money, all the coin. You can turn it back into real cash by just selling it at an exchange. And get $2 million in hard cash so you can pay employees and rent a building, and pay for electricity, and pay for computers, and start a company up. But the smart contract might also say it's now April 1st, and you raised $1.5 million. Too bad, so sad, you didn't make the goal. Which then triggers another part of the code that says, give all the potential investors their money back. So you are willing investors, but you won't invest unless other people play the game with you. Don't let Joe take the $1.5 million and run, because I will spend it foolishly. So that's kind of a lock, hard contract using software in a blockchain that can't change, that people can inspect and say, yeah, this looks good. You won't get the money until the full $2 million is there, and I've got the equivalent. It's like buying stock, except you're buying a Joe coin. And later on, if the company makes it, that Joe coin might be, let's say it started for $1 per coin. Now maybe it's $5 per coin. You can sell it for a profit, just like stocks. So that's an investment option for somebody starting a company using software as a component inside the blockchain, as opposed to just a transaction. There's lots of other examples. What's a Bitcoin? I knew I was going to trip over that. It's basically a virtual currency. It does not exist in the real world. It only exists as bits in a computer network that's spread out worldwide. I've got a copy of every Bitcoin transaction that's ever been made on that laptop. So do other people, because it's not centralized. It's no central ledger. As I showed you with the transactions, you can buy and sell it anonymously because you're not using your name. You're using some weird identifier. And if you try to forge, if you try to sell my Bitcoin, let's sell 10 of Joe's Bitcoin to you. It's not gonna work, because if I've kept my private keys safe, only I have the private keys, you can't authorize it because you don't have the magic number that's gonna authorize it. Okay, that's nice. Well, how about the value? What's a Bitcoin worth? When I first started teaching Bitcoin, I wish I had started earlier in the cycle, because this curve is flat for 10 years. It was worth $1 or $2 or $3, $30. Then it went up to $18,000 per coin. The law of supply and demand took effect. Now, this is when I started teaching the course. So I thought, for a class demonstration, what have I got to lose? $100? I don't care if I lose $100. I will go buy some Bitcoin and use this as a demonstration for this class and for other classes. And that was the wallet I showed you on my phone earlier. So I bought that $100. I was not stupid enough to buy it at the peak and watch it decline. No, I bought it at that peak. So for the next year and a half, I proudly showed my class, here's my Bitcoin wallet, my $100 is now worth 23 bucks. I'm a winner. So they were not impressed. And it continued to kind of flatten out. Just wait for a slide or two, things change dramatically. But I want to talk about during this time period. When you had Bitcoin back here, can you do anything with Bitcoin besides just sell it or trade it? The answer is, can I buy a McDonald's hamburger with it? Can I buy a pizza? And the answer is yes, you can. Well, there's other coins, I won't go into this, but there's Ethereum and Neo and Cardano and Dogecoin and others, but I'm missing a slide. Where is that? Well, I guess it'll come up in the future. No, I'm going to break the suspense. Somebody, you'll see, said, I want to buy a pizza. And I'll give you, I forget, it was 3 Bitcoins or something, but basically 30 bucks worth of Bitcoin. In today's pricing, in 2 years ago pricing, that person spent like $32 million for 2 pizzas. Most expensive pizzas ever bought on the planet. Today, I think the price is more like $90 million with the way that the curve has gone up. So, the point I'm trying to make is it's volatile, it's volatile, it's volatile. And it's going to go up, it's going to go down, it's going to swing like crazy. I'll show you more curves in a bit. But let's leave that behind temporarily. Let's leave Bitcoin behind. And let's just say, oh, Joe, you just said earlier you could put stuff inside a blockchain besides transactions and Bitcoins. And you said you could put music in there, or you could put other interesting information. Okay, let's look at some. I want to look at what could the government do, because I've given similar speeches like this to every county clerk in Colorado at their conference, to look at how could they use blockchain for property transfers, deeds, trust, for example. Or your mom dies, you got to settle her estate. I don't know how many of you have had to settle an estate through probate. Yeah, it's not fun, is it? It's a lot of work and it can take years. Or you back there were interested in supply chains. And we'll talk a little about that. Or trading energy. So let's start with some government apps. This is a typical deed of trust. If you own a home, you've seen this type of document in the past. Don't bother to read it, it's the usual boilerplate. Except it's got this little thing here added to it, a little addition. So it just looks like any ordinary Larimer County deed of trust. And if you look at a closer look at that block, it says, this conveyance has been recorded in smart contract, and it gives this weird number. It's a transaction buried in the blockchain somewhere. And this QR code, I just take a camera pointed at it, will immediately bring up on my laptop that transaction that says, yeah, this actual property transfer did take place between person A and person B. And remember, what goes in the blockchain stays in the blockchain. You don't lose your records because it's distributed. There's hundreds of thousands of copies of this thing all around the world. And that might be quite convenient for birth records, death records, just even following genealogy. It would be quite interesting. So, this is a real transaction from the state of Delaware that was recorded on blockchain. Here's an interesting one. You've just been stopped by the police with this really modern looking body cam. If you see one of the cops carrying that around, You think, wow, I'm back to the 50s. But we're talking about dirty cop here in this case. And the dirty cop planted drugs in your car, and the body cam recorded that. And now I'm going to take you to court because I found drugs. We might not pick on you. I haven't picked on you yet. Alter every frame of a video. So, you know, video is just a bunch of still pictures, click, 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 click. Every frame is put into a section of the blockchain, locked in place with that digital fingerprint. Chain is attached. Put in another block, another piece of it, another frame, another frame, another frame. You can't get rid of the incriminating planting of the evidence. So there are cameras on the market that build blockchain data. I bet you didn't know that. Here's another one. Voting, running elections. Many countries would like to have honest elections and proof of honest election. What goes in the blockchain stays in the blockchain. So we can all come to an agreement that yes, candidate A got 3 votes and candidate B got 5 votes, candidate B won. You know, and we do that on a much bigger scale, of course. Here is, so those are some governments. So if we're talking about vital records and things like that, let's take that one step further. I was at a blockchain conference in Golden a couple years ago, and I met these 2 interesting people from Montreal, Canada. And they had started a startup company called Immutable. Immutable, what happened is, like for almost all of us eventually, their mother had died, and it took them 2 to 3 years to settle her estate. She was relatively wealthy. She had brokerage accounts, she had bank accounts, she had credit cards, she had the last will and testament, she had homes she owned and rental homes she owned, she had all sorts of stuff. And when you try to settle an estate that's complicated, well, what's the first thing you do? You go to the county clerk and you get a death certificate. You have to prove the person who's actually died. I just had enough trouble. My mother-in-law is 91 years old. She just moved here to Loveland, Colorado from Las Vegas. And for me to just change her address and change her bank where her Social Security checks are deposited and her pensions are deposited was a pain. It took me a long time to do just that. She's still alive, I think. So, don't go there, Joe. Now, you want to settle an estate. You will call the bank and say, would you please close my mother's account? Well, would you please prove to me that she's dead? Oh crap. Back to the county clerk's office. Give me 20 copies of that death certificate. Get them all notarized and stamped, because it's got to be a legitimate document. Close this account, go to MasterCard, close that account, go to the brokerage, sell all the stock. Step by step by step, you got to do all these proof points. Every one of these organizations, MasterCard, a brokerage, every one of them has their own methods by which they do business. They got their own database, they got their own auditors, their own set of regulations that they have to operate under, and every one of them operates somewhat differently. So the communication between them, who's got to do that? You do. You got to walk it. It's called sneakernet. You walk it from place to place with your sneakers, and you try to get through all these transactions that you want to close off. So what my friends from Montreal did was saying, let's let the county clerk's office, since we got vital records, put the death certificate on a blockchain. Blockchain's public, anybody can get it. And since we have proof points that it was the county clerk that put it on the blockchain, just like that property deed was put on the blockchain, anybody can see that this death certificate is valid and signed by the county clerk's office. So I can go to MasterCard or the bank brokerage and say, I need to close this account. Can I have the death certificate? It's at this address on blockchain block. I can just text it to you. Oh, okay, we go take a quick. You're right, okay, I'll close the account. You're done. They shortened a 2.5-year process down to a year. It's still long, but that is a phenomenal achievement. And now they're trying to get more digital. They're operating in Canada. They are a profitable business. So the idea of settling people's estate is a pretty good application of blockchain. Why? Because it's a common denominator. Remember I said the word, I couldn't pronounce it, and enabling technology? It's coming on this immutability and this credentialed, who can put this in? The person with the keys can put the transaction. Yes, I'm the county clerk. Yes, I signed this death certificate. Only they can put it in. those properties allowed people with totally independent businesses to communicate through the blockchain to allow transactions to happen outside the blockchain, verified by data in the blockchain. So that's kind of a neat idea. Let's go to supply chains. There's lots and lots of supply chains. This is a food supply chain. We got somebody who sells seed, a provider, and we got a farmer who grows the corn or whatever the thing is. Then we send it to Kellogg's, who processes it and magically turns us into Cheerios. That's oats crap. Okay, this is all over. We get the provider with the seed, we get the farmer growing oats, the Cheerios factory, then we send it to warehouses and distribution. And so you can see the chain of custody changes from organization to organization to organization. And remember, just like in the death case I was talking about earlier, these are different people with different systems that don't communicate with each other. Everybody has their own database, their own records, their own ledgers, their own everything. We're going to get to a problem soon. Goes to the distributor, your local supermarket or corner market, whatever, stocks some Cheerios on the shelf, and then you go and buy them. Well, I'm waiting for somebody to read the bottom of the slide. I'll wait. Still waiting. Oh, come on, isn't anybody going to take the bait?
But what about listeria outbreaks?
Oh, I'm glad you asked that question. So, you probably have read in the past about the listeria outbreaks on romaine lettuce or Rocky Ford cantaloupes, right? Which was the farm in California that had the listeria problem from this romaine lettuce I bought at King Soopers? And the answer was, we don't know. Because they didn't. And they had to do other ways of tracing and stuff to figure this out. Whereas if every time a transaction was made on the supply chain and were recorded in a blockchain that's public, you could look at a barcode on the end product and find out where was it made, who trucked it, which factory built it, all that stuff. And you could say, this batch has this barcode, and it followed this chain, but this batch followed this barcode to this farm that had the listeria outbreak. And we can trace the whole supply chain, which makes that a kind of a useful thing. My favorite story is one that did not use a blockchain, and so my students, so Sierra Nevada's good beer. I like Sierra Nevada. They had a problem a couple years ago. Shards of glass inside some of their bottles. You remember that in the news? No? So you really don't want to drink beer with shards of glass in it. I just advise against that. And so, which processing plant caused the problem? They did not know. Only 1% of the bottles were contaminated. 1%. They had to take all their stock off the shelves and trash it because they didn't know which one. But if they had followed some kind of supply chain mechanism, and blockchain isn't, you can use that as the substrate to put information in, it makes it a neat way to say, oh, let's take a look. I'm the retailer, I'm going to scan my bottles. This one came from this factory, this one came from that factory. This one has shards, that one doesn't. We know which factory's at fault. And now, all I have to do is look for that same barcode, and I can only trash 1% of my bottles instead of 100% of my bottles. That would be really nice, but they didn't have that done. My students, in response to this, in cooperation with the School of Business at CSU, built a product proudly called, get ready for it. Would I be so honored? It was called Beer Chain. Similarly, in Wyoming, they invented something called Beef Chain. Because free-range beef ain't always free-range beef. And the profit margin for being a rancher isn't all that great to begin with. Even despite, if you look at the price of beef these days, which was like went to Costco and just about had a heart attack. There are counterfeit products. People claim something is free-range beef. It's put on supermarket shelves. Do you know the difference between what's real free-range and what's not? No. But with the code on the package, you can trace it through its complete supply chain and detect forgeries. So blockchain's got some interesting applications. Let's go through one more. I'm just trying to get you out of this as always Bitcoin mentality, okay? I work with NREL down in Golden, National Renewable Energy Lab. They have a blockchain project going on right now. And I do a lot of cybersecurity with them as well. And one of the things NREL is interested in is something called Transactive Energy. Whoa, that's a mouthful. What does that mean? What that means is the world is going to microgrids. We have these huge grids now with gigantic coal-fired or nuclear or whatever power plants, steam powered usually, and I have friends in that industry who are power plant operators. But we can't keep going like that forever. There isn't enough coal on the planet to keep us going into 2050. So we need wind power, we need solar power. Side story has nothing to do with this talk. I just took a drive to deliver a car to my son in Atlanta, so I drove through eastern Colorado into Kansas and stuff. And I don't know if you've taken this drive recently, but there's huge wind farms out there. Just gigantic, many, many hundreds of wind turbines. And what really bothered me the day I did this drive, which is only a month ago, was these wind turbines disappeared into the fog. Except it wasn't fog, it was smoke. And that really bugged me, that I could still have that same thing happening at the Kansas border and past. Holy cow, we got a problem, folks. Anyway, microgrids are, I got a small wind farm, I got something on my house, I got maybe some wind turbines, we got storage devices, Tesla battery, wall batteries, whatever they're called. When my house has sunshine, I'm generating electricity. Other times I might need electricity. But this is a marketplace with market pricing, spot pricing. And when that happens, we have to wait to do those spot trades. I'm going to give you want to buy 6 kilowatt hours of electricity from my surplus? You're welcome to it. It's 3 cents a kilowatt hour, way cheaper than the utility, which is typically around 10 cents a kilowatt hour. So here's your spot price, here's your electricity. We've got to record that transaction somewhere. Somebody bought it, somebody sold it. And this happens a lot, and it happens frequently, such that if we used a centralized database that's, say, Excel powered, they can't keep up. But to do it on a public blockchain, it's distributed, you can put microtransactions into the blockchain and keep track of who sold what when, and then do the accounting at the end of the month, figure who owes whom what. And I've had conferences. I don't know if you realize that the university has something called the Energy Institute. If you go up College Avenue a few blocks, you'll see a big red brick building on the right, the old powerhouse for the city. It is now a research laboratory for energy, and they work with NREL as well. And we built a conference. We had speakers from Duke University, not Duke University, from Duke Power. Totally different, but big energy company. You would think a big energy company would be fighting this tooth and nail. No, they're embracing it. What's the opposite of tooth and nail? And say we need technologies like this to do our energy trades when we have this going. So it's called Transactive Energy. So those are just to take you out of Bitcoin, 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 Bitcoin. This is useful for other stuff. It's an enabling technology. But you still want to know about Bitcoin, don't you? I knew you did. So let's talk about the money angle, which is approximately, in this case, 45 degrees. Come on, it's a bad joke. And of course, we got the little girl in bed with bedtime story. It's about time, that other stuff's boring. And we talk about money, so let's talk about money. What's the difference between fiat money, money printed by a government, and cryptocurrency? So first of all, let me define fiat money. Money, back when I was a boy, it was backed by gold or silver. The gold standard is dead all across the world. Very few currencies are backed by real bullion. And besides, there isn't enough gold bullion in the world to cover the amount of printed money that exists across the world. And so, we have what is known as fiat money. Federal reserve, it doesn't say silver dollar on your dollar bills anymore. It says Federal Reserve note. It's backed by the good faith that you put into your government and other people that they will accept this as currency. And it isn't backed by anything else. It's all a system of trust. And governments do collapse, inflation does happen, weird things can happen with fiat currencies, just like with Bitcoin. This is also following the same rules. I'll show you in a little bit. There's a bunch of them. I showed you the massive fluctuations in price. There is another kind of cryptocurrency called a stable coin, and it uses some remarkable mechanisms to lock the value of, say, a USD coin or a Gemini or a Paxos to the dollar, such that it does not fluctuate up and down widely. It always stays equal to $1. Because honestly, I would hate to go to McDonald's and buy some French fries for something whose price I bought for $2 a Bitcoin, but now is worth $46,000 for a Bitcoin. If I'm paying Bitcoin for them, I'm paying a hyper-inflated price for that bag of French fries. Not cool. I'd rather pay with something a bit more stable, and these stable coins are trying to do that. Nevertheless, does Bitcoin exist in the real world? No. These do. I have some right here. Here's that $5 I promised you. So, damn it. It's real money, right? So is $5 worth of Bitcoin real money? It is backed by the same thing fiat money is backed by. Your trust in a system that people will accept as currency, or governments will accept it, around the world. And that's how that works. It may be just bits in a computer network, but it is money. It's cryptocurrency. And so, let me give another example of trading. If my parents were, say, in the Philippines, and I'm working hard here in the United States, and I make some money, and I want to send them some money, how would I do that without cryptocurrency? Well, I'm going to go to Wells Fargo or a bank or something, and I'm going to do a wire transfer, which has a wire transfer fee, which is ridiculously expensive. And then the other side is going to take a fee, and pretty soon my $100 I sent to my mom is now, only $40 or $50 or something like that. I mean, fees can get ridiculous. But if I do it with a blockchain, I buy $100 with blockchain, I pay a $3 fee. She goes to an ATM in Manila and says, because I transferred the blockchain, that Bitcoin to her, and she just does the reverse transaction, sells it, and gets the full value of the money minus a $3 transaction fee. Much more efficient, much more fast. It's instantaneous transfer across the computer network. Is it money? Yeah. It follows the same rules as real money. Because this is all coming out of economics class. Let's look at some fluctuations, and let's look at some other factors that go into this. This is yesterday's price of a single Bitcoin. It's no longer $3 or $10 or $100. It's $46,900, almost $47,000. It was yesterday. It was at $50,000 the day before. It dropped quite a bit in one day. I'll show you that. It also says, of all the Bitcoins out in the world, there's $882 billion, that's billion dollars of Bitcoin minted at this moment in time. That's a lot of value. This is all about the word value. And we traded $3 billion in the last 24 hours. Well, that's an interesting graph. What's driving the price? What's making this go up to where I bought it here? I really wish I bought it here. Really, these people are millionaires beyond belief. Deadly serious about it. I'm not making that up. No, I bought here, but I also bought just yesterday, and I'll show you why. Prices go up, prices go down. What goes up can come down. Well, here's my pizza slide. All right, 8 years ago, now it's 9 years ago, someone bought 2 pizzas with Bitcoins now worth $82 million. Yeah. So don't you wish you would have hung on to that? No. Holding can be good. But, it was historical. It was the first ever Bitcoin transaction for a tangible asset, pizza. In El Salvador today, you can buy McDonald's with Bitcoin. All right, as I said, it was $46,900. Here's what happened yesterday. Bam! Now, that's not zero. This is starting at a bigger number, $40,000 to $50,000. This zero is down here. So that wasn't a complete loss of value in the Bitcoin network. it was only a 15% drop. A 15% drop is pretty significant. What happened yesterday? El Salvador went public with their national currency going to be Bitcoin. And you can buy and sell anything in El Salvador with Bitcoin now, which is pretty intriguing thought. And other countries are starting to follow suit. So they had some startup problems and caused some nervousness on the part of people buying and selling Bitcoin. And the price, like all market things, supply, demand, what's in the news. I mean, it's amazing how stocks get affected by fake news, let alone real news. But it dropped 50%. So I said to myself, being the market genius I am, I said, was it buy high, sell low, or buy low, sell high? It's one of those two. And so I said, Dad said buy low, sell high. That was it. So I did put a lot of money in, but my original, remember that $100 investment? The day before yesterday was worth $500. So I'm trying to show my wallet to my class and how hold up. Look at that, I made $400. Genius. So I bought $400 more, and it dropped, so that $500 is now worth like $400. But then I put in $400 more with my expectation that this is going to correct. That was a glitch in the system in people's confidence. Will it go up? Oh please, oh please, oh please, oh please. I don't know, but I'm willing to make that bet, but I'm not willing to put thousands into it. I will put some money into it. So that's why I now have $750 in my wallet. Some of that is pure profit. But then you still have to ask yourself, if it's money, and it's not fiat dollars, it's this virtual set of bits on the computer network, why is it worth money? And I'm going to try to give this article some visibility. It's really worth reading. You just go to Investopedia, go do a Google search for why do Bitcoins have value? And you'll likely get this article. It's one of the best written articles I've ever seen. Write it down, because I don't think the library's going to give you copies of the slides, or if you want to. This is recorded, I guess you can look it up again. But basically, the reason Bitcoin is worth dollars is it was designed to be worth dollars by a person named Satoshi Nakamoto, which is a completely made-up name. Nobody knows who Satoshi Nakamoto is. Is it some cryptographer in New York? Is it somebody in Japan? Nobody knows. It's a pseudonym. Some people think it's a consortium of 3 or 4 very famous cryptographers that knocked heads together and came up with this idea. But it's also really interesting things. It made anonymous money transfers possible, digital money possible, and didn't need a central bank. It was what's it called? Disintermediation. It's a mouthful, but it's what it created. Now, I don't know how many of you are old enough to remember bearer bonds. Ever heard that term, bearer bonds? Some of you. What a bearer bond is when a city or municipality says, I need to build a new library, they're going to need a loan. And so they issue bonds, and they'll say, you can buy this $1,000 bond for $500, and after 10 years it will be worth $1,000, and we're going to give you $1,000. But today, your name is on that bond, just like stock certificates. Your name is on that stock certificate. After 10 years, you go and cash it in, but the government knows you did it because they want their taxes. Back in the day, when I was a boy, my dad bought municipal bonds from where we lived in Michigan, and they were bearer bonds. It didn't say pay to Robert Gersch. It said pay to bearer. Whoever walks into the bank with this piece of paper gets paid the $1,000 for this piece of paper. In this case, he had quite a few $1,000s in this. And I asked him, well, why do you want bearer bonds? He goes, as he's trying to look really honest, I don't want to pay taxes. You can't tax what you can't trace. Is it legal, ethical? I won't go into that, that's for you to solve. But he basically cashed it in and nobody knew he had the transaction. And as it turns out, another thing he taught me was that any good economy needs, believe it or not, a black market to survive. You have to buy and sell things in secret, anonymously. I need to give you that $5 without anybody knowing. It keeps the oil flowing. There's the big bucks and there's the the black market, but it's a necessary part of it. Go ask an economist. This was the first way of doing it digitally, Bitcoin. There was something earlier called DigiCash and a couple of other things, but they had problems. They didn't really work right. And, oh my God, they allowed double spending. I bought 2 Testarossas, thank you. So we had to solve that problem. Satoshi Nakamoto, or whoever that is, took these libertarians that wanted digital money and made it real with Bitcoin back in 2010. And like any investment, this can be used as a utility. What is a utility? I buy tangible goods, a hamburger, a pizza. It can be an investment. I hold it, I sell it, I trade it. You can look at Bitcoin either way. Okay, what does this article have to say about money? I've got about a few minutes and then I'll open up to questions. A currency has to have some interesting attributes before it's worth anything. Mostly they function as a way of storing value and it's a unit of exchange. I really don't want to bring my donkey and trade it for your bushel of corn. Well, bartering is like hard. But I would easily give you the $100 bill for the thing because it's a unit of exchange. And it's backed by our common trust that you'll be able to take that $100 and go exchange it with somebody else and keep the money floating through the economy. But these are the 6 attributes mentioned in the article: scarcity, divisibility, convenient, utility. I can buy stuff with it. I can transport it. Transporting my donkey is going to be a little harder. That lasts for a long time, like minted coins, or we're going to replace a paper dollar. And it'd be nice if it were difficult to counterfeit. Well, in blockchain, it's really, really hard to counterfeit. Really hard. You've got those private signatures. What you can do, by the way, is you can lose money. It's easier to lose money than counterfeit. How do you lose money? Here's my wallet. It's in here. My private keys are in this device. And I forgot to back it up. And I trashed it somehow, or I threw it away for a new iPhone. And about a year later, I realized, oh, crap. I had Bitcoin on that phone, in the wallet in that phone. Where's that phone? It's in the landfill. Start digging. Billions of dollars have lost. Make sure you keep those keys safe and backed up. And talk to me some other day about how to do that. So, divisibility, dollars go into cents. Bitcoins, I can't spend $46,000 in a chunk. You can break it up into tens, hundreds, thousands, tens of thousands. So I can sell $46 or $4 worth of Bitcoin. So it's divisible. It's scarce because there's a limited supply. Only so many are minted at a time. I can buy stuff with it. I can move it around the network real easy. It's just like fiat currency, except it's bits. They both follow these rules. And that's why you want to read that article. And it'll tell you much, much more. All right, so assuming I've talked you into the fact that Bitcoin really is money, cryptocurrency, and it's worth having some, how do you get into the game? Before I read this slide to you, I'm going to go to the next slide and back up. Because like any good presentation on anything that's going to get me into trouble, well, I'm going to have my disclaimer to cover my butt. Any money that's used for speculative investments like cryptocurrency should be money that investors are willing to walk away from. There's always risk. But there's always reward. As I said, there are Bitcoin millionaires and billionaires. And there are losers to the game too. So back to this. In the game, you can simply not create an app, but you can write the app from scratch if you're a computer scientist, but it's not that hard to do, it's all public code. You're more likely to just download a wallet application onto your phone or your laptop. And once you got the wallet application, you'll say, create me an account. It creates those key pairs I talked about earlier. Sign with the private, only you have it, and keep that key safe. And there are ways to protect that I should go into in this talk, but I don't have enough time. Anyway, you have this digital wallet. Now, if you don't want to do that, you can just go to a website. That's an exchange website. Coinbase is one example of many. It's the biggest and the most popular. And you can just say, they have to follow laws set by the SEC. It's called KYC, Know Your Customer. So you can't just get an account anonymously. You have to give them your name and your address and your driver's license and other identifying information to prove you are who you say you are. And now you have a Coinbase account. Once you have that, they know the customer. But now you're in control. You can create, just have thousands of these IDs. And buy and sell and trade with these IDs, they're going into the real blockchain. Who is that person? We don't know. It's only when you cash out back to Coinbase that a transaction is visibly converted into fiat money that it might become visible again. Now, people have criticized Bitcoin as a criminal activity. This is good for money laundering. This is good for drug dealing. You've probably heard about Silk Road, which was a great place to buy arms, missiles, people, slaves, sex trafficking, drugs. Yeah, they've been shut down. People were buying stuff using Bitcoins. So can it be used? Yeah. Any technology can be used for good or for bad. But enabling technology is neutral. So we try to put regulations in place that prevent those kinds of things happening. Sometimes they work, sometimes they don't. But getting back to this, you can create a Coinbase account real quickly. You can do it right here, right now. I can show you how. And then you create those accounts in your wallet, and you might say, take my Visa number, I want to buy $1,000 worth of Bitcoin right now. And you can do this right here, right now. And then you can just let it sit there for 2 years. And then in 2 years, you got to look at it and say, gosh, I wonder if that went up or down. Which way did you want it to go? That way. And you can sell it on Coinbase. But whatever you do, don't throw away that wallet. I threw that laptop away 2 years ago. You dummy, you had $1,000 worth of Bitcoin, and it's probably worth 10 million now. And that has happened. Billions have been lost forever because they cannot unlock it from the blockchain because they don't have the keys anymore. So just, if you do it, know what you're doing. Read some articles. I already read this to you. Let's go to a couple of other aspects of color today. NFTs, non-fungible tokens. A cryptocurrency is called a token, a fungible token. What does that mean? One Bitcoin is just like any other Bitcoin. You can trade them, they don't look any different from each other. But a non-fungible token is unique. There's something about it that's special. It's the data that's attached to it. And so, artwork. We're going to democratize, just like we democratized anonymous money transfers, we're going to democratize and liberate, because we're a bunch of libertarians, artists from galleries in the middlemen. And I'm going to sell my work directly. So my daughter's a bug daughter. My granddaughter, I hate the middle, this is old, oh my God, is a really good digital artist. And she can take her art and create, quote, an NFT, publish her art there, and sell, I'm going to say like a dolly. I've got some seller dolly, I've got some Max, what's his name, Max? No, I wish I had that rich. Not Maxwell Parrish either. But anyway, some really good art. And it's, you know, it's a print. And it's a print number 100 out of 250. Typical, you see that on any lithograph or print made. So my granddaughter could take her artwork, publish it in an NFT, and say, I'm going to sell 250 copies, and I'm going to sell them for, say, 25 bucks a piece. And then I'm just going to get that 25 bucks for each copy that happens to sell. It's going to go to a marketplace on a website. You can do it on OpenSea or on Rarible or about 20 other sites or more that have these kinds of exchanges. And people might like your art and say, I want a copy. Well, say, wait a minute, it's not, you're not owning the artwork itself. Anybody can go look at it, but you're owning the rights. You actually, it's like the Mona Lisa. Anybody can go to the Louvre and go see the Mona Lisa, but only one place owns it, the Louvre. So only these people actually own the rights. It's just the bragging rights, in a sense, of NFTs. You might question the logic behind that. Because some of these NFTs have appreciated in price to millions and millions of dollars for stupid things like these two pictures.
Serious?
And that's the title of my talk.
Oh, yeah.
Seriously? If you want, you can say my original name, WTF. Yeah. So it doesn't have to be artwork. It can be a song, music. It can be a poem. It can be a recipe. You can publish it in an NFT and sell it. What's really nice about that, though, is art is constantly traded. So you buy a copy, after a couple of years you say, oh, I don't want to sell that. It's actually appreciated in price quite a bit. I'm going to try to profit on that. And you sell it to her because she's got $5. And she buys it. Every time that transaction occurs, my granddaughter gets a cut. So she's making money not just for the original sale, but every resale along the way. That's kind of cool. So NFTs, I don't have enough time today to go into all that, but you ought to know they exist. It's a whole series of lectures I give at the university just on how does this really work. I don't think any overview of blockchain is complete without at least mentioning the term non-fungible token. It's poems, it's artwork, it's songs published on a blockchain that you can buy and sell and trade, just like you can buy and sell and trade Bitcoin. And the reason they're called non-fungible is it's got this picture, and it's the only one like this with that picture. I'm the original artist. I've signed it, I proved I'm the original artist, and you just bought it, you signed it in the transaction to buy it. So it's proof of ownership. There's one other area with too many words that I don't even want to begin to read, but if you want to really go crazy, and the SEC, Securities Exchange Commission, is starting to look at this a little more closely now. This is called DeFi. You may have heard the term, wondered what it meant. Decentralized finance. Why do we need banks anyway? We got Bitcoin now. Why don't we got Ethereum, we got Dogecoin, we got Cardano, we got you name it, we got it. Spot loans. I'm gonna make 10% on my Bitcoin, because I'm gonna loan it to you, and the smart contract says you gotta pay it back by such and such with so much interest. And it's locked into the contract. So you need the money. I don't need the money, so I'm happy to loan it at 10% interest. These days you'd be lucky to get 0.1% interest in a bank. There are even mechanisms where you could borrow for about 3 minutes, $1 million, just like that. But at the end of that 3 minutes, you got to pay it back. You say, what good is that? Well, I borrowed $1 million, I take that $1 million, go invest it in something else that I hope will make a lot of money in the short term, and then I take my $1 million plus my profit and pay back the loan in that transaction. Does that sound crazy? It happens. So DeFi is a subject, if you want, I can always come back and give a second speech on either NFTs or on DeFi or on both. But for today, that's it. I really thank you for being here. I really don't like talking to empty rooms. And I hope
Any questions? Yes, sir. How is it that these puzzles that Bitcoin mining solves gets more difficult? Because 10 years ago, someone could do this with a setup in their bedroom, but now it requires these banks of.
well, okay, now forgive me if I get a little technical.
Can you repeat the question?
Oh yes, for the rest of the people, why is this puzzle to be solved get so difficult where before you could do it on a laptop, but today you need this whole mining rig, a thing that do terahashes per second. And the reason is, let me just give you what's called a simple puzzle. Calculate what's known as that digital fingerprint, a hash. So you take anything, the Library of Congress, your name, any piece of data you got, a picture, and you run this calculation on it, it creates a 32-byte number. And it will be unique. You change one bit, and that number completely changes to something, not just a little bit different, a lot different. So that hash is a one-way function. You can't take the hash and go backwards. You can only take the data and create the hash. It's a digital fingerprint. Now that I can do that calculation, just assume there's some math there. Suppose I said, I want you to calculate this hash, but I want to have one leading zero at the front end. It's 32 bytes long, one's one little zero at the front end. I do the hash, and the first number is a 5. Oh, crap. Well, what happens in the block, in a blockchain, there's a little thing called, nonce. And I, as the blockchain miner, can change that nonce from 0 to 1 to 2 to 3 to any number I want. I might go sequentially. So I change that one number, which changes the data in the block. I calculate the hash again, and this time I get a 7 as the first digit. Crap. And I do it again and again and again. It might take me 20,000 tries, but I finally get that leading zero. I say, I won! I won! I publish it to the blockchain. I get my mining reward. Maybe it took me 10 minutes on a laptop. Well, now more people enter the game. More people are trying to calculate it. They're trying to calculate it faster, so they get a faster machine than a laptop. They get a pretty good, beefy machine to do the calculations. Blockchain has got a thermostat attached to it. And it says, I want this calculation to take about 10 minutes. And all of a sudden it's starting to take 5 minutes. Yeah, I don't want one leading zero, I want 2. It starts getting easy again as I make more powerful computers. Yeah, I don't want 2 leading zeros, I want 4. Which might take me 1 billion calculations before I find one with 4 leading zeros. Now I've got this whole rig in Fort Collins warehouse somewhere, and it's asking for 10 leading zeros. That might take you pure dumb luck. It's like playing the lottery, Powerball. But you make the thing easier and harder by just saying, how many leading zeros do you want? Does that answer your question? Yeah, thank you. Others? David?
So,
David and I used to work together many, many years ago. Haven't seen him for 30 years, and he shows up here.
so the question I asked
There's
Joe.
no accounting for taste.
So the question I asked Joe before we started is, why shouldn't all of us have this bank of computers in our basements mining Bitcoins?
I actually answered that question a little bit earlier when I said the formula for profit is revenue, Bitcoin reward, minus how much electricity did you use up, and air conditioning, and the cost of your rig, and what's left over is your profit. And if that profit's too small, you're not going to have a big incentive. So not everybody's going to want to play the game unless it's really worth it to them. So not everybody should get in that game. But when China dropped off, the game got a little bit easier. You could actually enter the game now. There's no reason you couldn't have, and you can go get the software really easily. Run it in the background on a laptop overnight, and just be a small player where you're competing with people all across the planet, but you might just get lucky and crack the puzzle and publish it and get the reward. You're getting 6 Bitcoin, that's $240,000 for God's sake. I think it's probably worth playing the game. Dave, just go ching ching and take it from there. Now, is it worth going to buy a huge rig? That's for serious players who generally join up with other serious players to build this consortium of across the world of, we're going to get your little machine versus my 70 million terapashes per second rig. Who's going to win? Likely. Probably the big rig. So small players do get a little bit eked out. Small players used to be able to play pretty well, but it's gotten so complicated, the puzzle has gotten so complex that it's taking these bigger rigs to do it. So that sort of answers the question, I hope.
Well, so I guess the question is, so if you go and invest
Mm-hmm.
how much money could you realistically expect to make?
Well, I've got all the math in a set of slides in my laptop that I teach at the university, and if you'd like to look at that afterwards, I'm happy to show you the exact math on how much money you would make. But for me to just off the cuff give a number, I would mislead you right now. But come and visit me at the university or something. I'm happy to take you through the math. Very happy. Any of you have questions, just send me an email, jgersch@alstate.edu. Yes.
The transaction.
Simple question.
Let's start with the person back in the back.
Okay. Which one you should choose between Ethereum and...
Oh, I was waiting for that question.
And then one other. I've been very simple about it. I just have a PayPal account.
Mm-hmm.
Now, is that adequate? I mean, I
Yeah.
don't have to back that up, really.
No, you don't have to back up the PayPal account, but you do want to back up your crypto keys and your digital wallet for the cryptocurrency. That's the one that's important.
Where do you
PayPal is
access
PayPal.
that? How do you get to that through PayPal?
Well, first you have to create the digital wallet, and that's Coinbase or something else. And you can just say, how do I create a digital wallet for, say, Bitcoin? And you'll get hundreds of references that say, use me, use me, use me.
Okay.
Once you do that, then they say, how do I tie PayPal into that to make a purchase? And honestly, when I go to Coinbase, and if I said right now, I want to buy $100 more of Bitcoin with cash, it's going to ask me, do you want to use your bank account, my debit card? Do you want to use PayPal? Do you want to use, it's already hooked to PayPal. So you can just use your PayPal account to pay for it.
But you also need to have...
You need to have the Coinbase account, the wallet. If you want to be a player, you got to do that. Now, to answer the second question, I thought I heard somebody say, or all of you say, how do I choose? Should I buy Dogecoin? Should I buy Bitcoin? Should I buy Ethereum? Should I buy Cardano? Should I buy USD coin? And my answer to you is, get on Reddit and put as one of your interest areas cryptocurrency, and you will start getting pundits galore publishing articles on, now's the time to buy Dogecoin. No, don't do it now. Elon Musk just said something, and the price dropped 20%. Oh, Elon Musk changed his mind. Buy, sell, buy, sell. And so like anything, you pays your money and you takes your chances. So I will not give you advice on which one you should buy. That would be just wrong on my part. But I will say, there are very good opportunities out there. Some people have an investment strategy that says, I only want to buy coins that are selling for a penny a piece in the hopes that hyperinflation will happen. Because I can make a lot. I'd rather take the risk and lose, I'll buy $100 at a penny a piece, because if it goes to, $10 a piece, that's a huge profit. But if I buy something that's $100 and it only goes up to $105, that's not a huge profit. So some people play the game, I'm gonna buy new entries in the marketplace. Some people play with the established market, like Bitcoin. It depends on your personal preferences for risk. That's really about all I can say about that. And you had a question.
Okay, Jacob, this is the last question.
Okay.
I was just wondering if the transactions that you do with cryptocurrencies, are they taxable?
Yes.
And how do you,
So,
How's that get reported?
the way it gets reported
Excuse
in,
me, what was the question?
oh,
Can you
yeah, I'm sorry. The question was, why are you such a good-looking man? And how can you be so entertaining at the same time? The answer is, I picked good parents. My wife, yeah. Oh, I get to be boss as long as I do what I'm told. So to answer the question, really, the question was,
Well, what's that?
I'm totally lost. Is it when you buy and sell coins, eventually you turn back into fiat money, is that taxable? And the answer is, oh yes, the government wants you to pay taxes on like any investment. If you buy a stock, you buy the stock at $100 and you later sell it for $200, it's either short-term or long-term capital gains. Same thing with Bitcoin transactions. When is it taxable? Well, if you're using an exchange, that's why they use KYC, know your customer. They know you made a transaction that cashed out. They also know you made transactions that cashed in. They don't know anything that happened in the middle. And they don't care what happened in the middle. All that's hidden in the blockchain. I shouldn't say hidden, very visible in the blockchain, but invisible as far as who's this ID. So this is where it becomes real money again, which means you've done like selling a stock. It's now taxable income or taxable loss. It's a capital gain or capital loss, and that's cool. But what if you did not use Coinbase? What if instead you said, hey Joe, you computer scientist, you dashingly good looking young man, could you build me a wallet that I can just put some money into and do the stuff without somebody keeping records? And yes, I could. In which case you can keep this completely hidden from the government. Is that legal? I would say it's certainly unethical. Is it illegal? Probably. Would I build that for you? Probably. So yeah, there's always ways to hide cash, like bearer bonds. Or as my brother said, he's a lawyer, I've never met an insurance claim I didn't like. So you inflate prices. So thank you for your questions. Thank you for being here. I hope this was of value to you. And if you want me to come back, I'll come back.
Yeah.